Chapter 17, investment and business brokerage. In this chapter, we're going to explain the advantages and disadvantages of investing in real estate. We're going to describe the tax benefits of real estate investments and the effects of New Jersey Uniform Commercial Code. So basically, a lot of this stuff is we're going to be learning a lot of investment jargon, the lingo. Um, uh, but let's get through it. Let's see. So investing in real estate. Well, just like any investment, what is the purpose of investing? To get some
Okay.
sort of a return on your investment, to make money off of it, right? To get some
Yeah.
sort of an advantage. So, what are the advantages in investing in real estate? Well, you generate a return just like any other investment, but you could also use leverage, that's using borrowed money to make money, and inflation, using inflation as a hedge. We're going to learn what that means. So, as the property values go up with the market, simply holding on to the property, the values fluctuate and they go up on their own. So, you're using that inflation of property values going up while you did nothing to your property. You use that as a hedge. So, property values go up because you did nothing on the property, because real estate's a cyclical market. If the property values are going up, you could use it. Inflation as a hedge. It's You can use inflation to your advantage. Okay, and what are the disadvantages in investing in real estate? Well, it's not highly liquid, meaning that you can't sell it quickly, usually without taking some sort of a loss. You're not buying it in the morning and selling it in the afternoon like you can with stocks or bonds, right? And make money off of it. Uh, if you uh, if you sell it quickly, you're probably going to take some sort of a loss on the deal. Um, and it's not highly liquid. Okay, so uh, it requires expert legal advice. And there's a high level of risk if you don't know what it is that you're doing. There's a high level of risk for your money there if you don't know what you're doing.
Yeah.
All right. So, so. So let's highlight that. Page 327 is the first sentence. This next one is on page 328 about leverage. It used to be
Page
all on
27.
one page, so I got the screenshot from when it was on one page. So this is split between two pages now.
327 the page? No.
Yeah, 327 at the bottom of the page. You got the return includes, it's the last
Oh,
sentence
yeah.
of the page.
Okay.
Return includes total income, both direct cash flow and indirect benefits such as depreciation and appreciation, which and then continues on to the next page, 328. And then you go into this next sentence here about
Yeah,
leverage.
that's two page. That's
Mhm.
how confused.
Yeah,
Yeah.
see, every time they reformat the book, sometimes these things get cut up and split and put onto different pages than they used to be,
Mm.
which that's annoying because then I got to go through all the slides and start changing page numbers, getting new screenshots. All right. And then disadvantages is the next section there. Unlike stocks and bonds, real estate's not highly liquid, meaning that you can't cash it out and get your money out of it really quick without taking some sort of a loss. You're not even buying real estate at the beginning of the week and selling it at the end of the week. So it's not highly liquid like stocks and bonds where you could be trading them during the daytime. You buy it in the morning, a couple hours later you're selling it and you got a profit. Possibly. So it's not liquid like that. It requires a little more time for the markets to fluctuate and values to go up, or for you to do improvements on the property to increase the value, or for you to pay down the debt, increasing your equity. Okay, everybody got these highlights?
Yeah, I do.
So property can be held for appreciation using inflation as a hedge. So generally expected to increase in value and to show a profit when sold at some time in the future, because real estate values typically go up. Even though they fluctuate, they go up, they go down. If you look at the baseline where they started from, they're going up and down. It's still going up in value, even though they're fluctuating up and down. So it's generally real estate values always go up, up. So income property can be held for generating income, right? You rent it out, as well as getting the profit on the eventual sale. So cash flow is spendable income after expenses. It's the net, right? Remember, you live in the net. So
Net
cash
income.
flow is that spendable money because it's after all your expenses. It's your profit. Pyramiding through refinancing is where you keep refinancing to drain all the equity out of your property to reinvest it to buy more real estate. Okay, but if you keep doing this, all of your assets are going to be highly mortgaged. So basically, you buy one property, you build equity in it, you drain out all that equity, you refinance, drain all the equity out, and then you use that money to use as a down payment to buy more real estate. And you keep doing this over and over again. The problem with that is all of your real estate is highly mortgaged. It's you keep draining all the equity out. Okay, but by doing this, you could find yourself owning millions of dollars in real estate in a relatively short period of time, I guess. But it's all, you don't have any built-in value because you keep draining it to buy more. Now, equity is the difference between the market value and what's owed on the property. So let's do the highlights. On page 328, let's highlight what cash flow is. It's spendable income after your expenses, right? So the object of owning income property is to generate spendable income, right? It's called cash flow. You want that cash flowing after all your expenses, of course, Any expenditures, including taxes, operating costs, mortgage payments, whatever you got left over, that's your cash flow. So what are some of the tax breaks available for home sellers? Well, here's some tax benefits for the sale of your primary residence. We learned about this in chapter 8 or 9, whichever one was about the taxes, I forget. Both the federal and state government have exclusions from capital gains taxes from the profit of the sale of your primary residence that you're living in. You had to own the property for at least 2 out of the last 5 years before you sell it. Single filers can get up to $250,000 capital gains tax exclusion, and married couples filing their taxes jointly can get up to a $500,000 capital gains tax exclusion from both state and federal income tax. So if the owner the owner had to live there for at least 2 out of the last 5 years. However, if they live there for less than 2 years, they may still be able to take the deductions if it was due to one of the IRS allowed hardships. So those include job loss or transfer. You're forced to sell the property early because you're getting transferred for your job, or you lose your job. That forced the early sale of that home. Well, that's a hardship, so the IRS will still allow you to take those deductions from any capital gains that you may get. For health reasons, death, divorce, or multiple births. Those are all considered acceptable hardships in the eyes of the IRS. Now, can you use this? You could use this deduction every 2 years. because you got to live in it for
Oh,
at least 2 years, right? Before you sold it. So uh, you could use this deduction over and over again. So if you're if you're willing to move a lot, you buy a property to fix it up and flip it. Well, live in it for at least 2 years before you do that, and then you pay zero state or federal income tax up to $250,000 if you're single, to the state or federal government.
The, and sorry, this of you had to hold the property for 5 years, I believe.
No, you need to live in it for at least two out of the last 5 years.
The
So
5 years, yeah, exactly, yeah,
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 so you got to live in it for at least 2 years.
2 years, yeah.
Now, say you move it, you bought it, you lived in it for 2 years. Now you bought another investment property, so you're going to move to that one while you sell your previous one.
Yeah.
You as long as you lived in it 2 out of the last 5 years, you could qualify for this.
Yeah.
and it says may allow deduction. So that's some kind of deduct. They're gonna deduct like it's a loss, right? To the in to the owner.
Well, are you single or are you married?
Married.
So if you file your taxes jointly with your husband and you're selling your primary residence
Mm.
at a profit, you could sell it at up to a $500,000 profit.
Okay.
If you were to earn that much profit on the sale of your home, you would pay zero state or federal income taxes on the sale of that primary residence
Right.
for your primary residence only, not for investment properties, but for your primary residence. If you lived in it for at least 2 out of the last 5 years.
Okay.
Is that a good enough deduction?
Yeah, it may allow deductions.
All right.
Okay.
Remember, sellers must pay income taxes on the profit from the sale of any investment property, but not for your primary residence if you lived in it for 2 out of the last 5 years. So this is a pretty good benefit when you sell your primary residence. So a 1031 exchange. Okay, in the book it just says exchanges on page 329.
Yeah.
Let's do these highlights, and then we're going to go to the next slide I have, which basically summarizes it in an easier to understand way.
I'm adding 1031.
Yeah,
Exchange.
because this is specifically section 1031 of the IRS tax code.
Yeah.
So this is talking about how you could defer paying any income taxes on the sale of an investment property if you reinvest the money from that sale to buy another investment property. You could avoid paying any taxes, any income tax on that, if you reinvest it in buying another property. That's why they say it's a property exchange, or sometimes they refer to it as a like-kind investment, a like-kind exchange. It's or a tax-deferred exchange. So you don't have to hunt somebody out that has the investment property that you want and they want to buy your property and then you swap them. That's not what this is. That would be statistically rare to be able to find somebody who wants to buy your property and you want to buy theirs. So instead, the IRS says you could sell your property and then use the proceeds to purchase another similar like-kind investment property and reinvest that money, and then you don't have to pay the taxes on it. Not until you eventually sell the property and cash out and realize the gain.
Does mean you buy the property you sell for the same amount and buy for the same amount, so you don't have no profit, right?
Yeah, you reinvest all the money.
You don't reinvest all the money, exactly. Yeah.
Then you don't need to pay any taxes on it. So if you sell that property so if you sell that property at a profit, as long as you reinvest all that money in purchasing another investment property, you don't pay any taxes on it. But you need to let the IRS know that you're doing this.
Mm.
And, you know, anytime you communicate with the IRS, it's got to be on a special form, and there's strict timelines that you need to follow. Otherwise, you could lose this tax advantage. So I just want to make sure everybody got these highlights. Let's move on to the next slide, and then I can explain it to you a little bit
Yes.
more.
Yes, I'm good.
So some of the tax benefits of a 1031 exchange: the sellers must pay income tax on the profit from the sale of an investment property, but they may get a capital gains tax exemption for a primary residence. But in a 1031 exchange, this allows the investor to defer paying income taxes on the profit of the sale of an investment property if they reinvest it in another similar like kind investment property. So they wouldn't have to pay income taxes until they eventually cash out and realize the gain when they sell it.
Mm.
Strict timelines have to be followed to qualify for this tax deferment, though. So we need to be aware of that as real estate professionals. I always make sure that they either have their CPA, tax attorney, or whatever involved to do the communications with the IRS and the filing of the paperwork with the IRS. And I just have to be aware of what the time frame is, those strict timelines, so that my client can realize this benefit. So make sure you get a tax attorney or CPA to communicate with the IRS. And you must notify the IRS that you're going to be doing an exchange at the time of sale of the current investment property. Then the IRS gives the investor 45 days to search for and find another investment property. And then they give them a total of 180 days to close on that purchase. Now, it's not 45 days to search for a property plus 180 days. They give you a deadline of 45 days to find another property, and then 180 days total, including that 45 days in that total, to actually close on the sale of that property, to buy that property. Otherwise, you lose the tax deferment and have to pay the taxes on the sale of your previous investment property that you sold. Now, if the investor is selling one property and the next property that they're purchasing costs less than the one that they sold, they're realizing some of that gain and they're putting it in their pocket. That difference in value is known as boot. And boot is loot, and all loot is taxable. Ever hear money referred to as loot? You know, the pirate's booty, the loot. So boot is loot, and all loot is taxable. It's a capital gain. So let's go do some of the highlighting of this stuff. What is a capital gain? It's taxable profit on an investment. And the basis is the initial purchase price of that investment, whatever that investment is. See, this is where that investor lingo comes into play, whether it's real estate or it's something else. Capital gain, it's the taxable profit on the sale of the investment, whatever that investment is. And the basis, that's your base price that you use to purchase your investment, whatever that investment is. In this case, it's real estate. It's the initial cost for the real estate. And
Got it.
if you put additional money into the property to fix it up after you buy it, and you add that money, those costs, to the base price that you bought it at, that's known as the adjusted basis. So the basis is the initial cost to buy the real estate. The adjusted basis is the base price plus the money that you put into the property for any improvements, etc. So the adjusted basis is the basis plus improvements minus any claimed depreciation. It's the difference between the adjusted basis of the property and all the money you have in it. And its selling price, and then you only pay income on taxes on that amount. So you subtract the money that you don't pay taxes on the money that you use to buy the property or to fix it up. You subtract that from your sales price. And whatever's left over, that's the profit, which is taxable, and that's capital gain. So here we're going to have a math problem here, example showing you. Boot is when you're doing a 1031 exchange and the replacement property costs less than the sold property. The difference is boot, and boot is loot, and all loot is taxable. Okay. So the basis is your initial costs. So if you bought a property for $300,000 and then you dumped another $100,000 into it for improvements, you're all in at $400,000 into that property now, right? Everybody follow me on that? You're all in on $400,000 now into that property. Now, if you turn around and you sell that property for $600,000 and there's a $200,000 capital gain, if you were to reinvest all of that money into another income property, you would defer paying any tax on that profit of $200,000 because you reinvested it all to purchase the next property. Right? But let's take, for instance, if you sold that property for $600,000, you're in it for $400,000, you sell it for $600,000. There's a $200,000 difference, but the next property that you purchase is only $500,000. So you invested half of the profit into the next property. The other half, the other $100,000, you put in your pocket. That difference in value is known as boot, and boot is loot, and all loot is taxable. It's your capital gain. That's the amount that you cashed out. That's your realized gain. So when you sell the property on a profit, and then you reinvest only portion of your profit, whatever portion you put in your pocket is your boot. It's your capital gain that you need to pay income taxes on. Okay. We were just talking about boot and reinvestment. So if you sell that investment property, you're all into it for $400,000. You sell it for $600,000 profit. If you reinvested all of that money to purchase another property for $600,000, you pay zero income tax. But if you reinvest, you sell it for $600,000, you made $200,000, and the next property you're purchasing only is $500,000. You're only reinvesting $100,000, half of that profit. So you would pay taxes on the income taxes on the difference, the $100,000 profit that you gained, or you realized that gain by putting it in your pocket. That's your boot. And boot is loot, and all loot is taxable. It's your capital gain.
Only the difference.
Yep. Only the difference is taxable because you reinvested a part of it. So the part that you reinvested is not taxable when you're doing a 1031 exchange.
Okay.
All right. So that's it about 1031's exchanges. Now let's talk about depreciation. Before we did, in the previous chapter, we did math problems about depreciation and calculating
Straight and
depreciation.
compound.
Here, we're talking about depreciation as an accounting concept, not dealing with the actual value of the property. So the IRS allows people to, any large investments that you do, any business investments, you can deduct on your taxes, right? But depending on the size of what kind of investment it is, like you're getting into the real estate business. So if you buy yourself a new cell phone, and you're going to use it for business purposes, you could deduct that on your taxes. It's a tool that you need for your business. But any large machinery or large purchases for equipment, the IRS has lifespans for those items, and they need to be deducted over a period of time. You can't all deduct it against the income all in 1 year. Okay. So depreciation is the accounting concept to deduct the cost of the investment on any improvements on the investment property for taxation purposes. It's not a reflection of the actual cost of the value of the property. It's only used to reduce your taxable income before the taxes are computed. So a property value cannot be depreciated or deducted all at once. The asset has to be depreciated over a period of years, whatever the IRS defines as its life expectancy. Like if you buy a car or a van, because like a plumber, they buy a van that they need to do their business to carry all their stuff in, right? And
That's it.
I think with the when it comes to vehicles, they have to deduct that over a period of 7 years. I think that's what it is, over 7 years.
Yeah, 7 years.
Yeah, okay. But if it's real estate, well, you can't deduct the value of land because land does not depreciate. Remember that? So even when it comes to the IRS in this accounting concept, you have to separate the value of the land from the improvement on the land, which is the structure. So how much, how can you deduct it? You can't deduct it all in 1 year. If it's residential property as the investment, it has to be deducted over a period of 27 and a half years is its life expectancy. Commercial real estate has a life expectancy of 39 years.
49 years.
So let me put this into perspective by going to the doing a slide here. And I wrote a problem here above the top, but here, let's just do the highlights and write this note next to the title that the economic, because this is the wording that they use on exam. If you ever see this wording on the exam where they talk about the economic lifespan of an improvement, you know that this is the math problem they're talking about. And they give a problem here. If a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? First of all, what kind of real estate are they talking about if it has a lifespan of 27.5 years? They're talking about residential real estate. Residential property is divided by 27 and a half years. Like on the previous slide, residential property, the cost of the building is divided by 27 and a half years. Commercial property, cost of the building is divided by 39 years. Okay, so you guys got this in the title?
Hold on. Depreciation. I need to write it down. Economic. Right. Okay.
Just let me know when you guys got it.
I'm done.
Okay. So let's do this problem here then.
Ooh.
If a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27.5 years? Well, here's the way you figure it out. Ready? I made it an interactive slide.
Right.
$500,000 total property value.
Mm-hmm.
You got to subtract the value from the land from the total value to get the improvements value of $350,000. This is why even on your tax records, you know, when you get your tax bill, even the tax man, when they give you the assessed value, they show you the land value, the improvement value, and then the total value. They even
Right.
separate it.
They different.
Because when you do a tax appeal, You can only appeal the value of the improvement, not the value of the land. Why can't you appeal the value of the land?
So doesn't depreciate.
Mm-hmm.
That is what?
Because land does not depreciate. That's
Mm.
why.
Yeah.
So, now we have the improvement value here. Next step is we got to divide it by 27.5 years. That's the economic lifespan.
Okay.
And that gives us $12,727.27 per year that you could reduce your taxable income by before you calculate your taxes. So if you make $100,000 a year, let me pull up my calculator on my cell phone here. So if you make $100,000 a year and you subtract $12,727.27 from your $100,000, you're left with $87,272.73, which is taxable income. Now you calculate your taxes based on that income amount. Okay. Now, that's not the answer to the question, though. The question was, how much would be depreciated over 3 years? So you got to take this answer here and times it by 3. And there's your answer for this problem, if they ask it like that.
What is the how they ask? What's the last thing you said?
Question's right here. How much would be depreciated over 3 years? This is
Over
how
3
much you
years.
could depreciate from your taxes in 1 year, each year of over the next 27 and a half years. Okay. So over 3 years, you would have depreciated 38,181 and 82 cents. But this is the same way that they ask the problem on exam. It's the same exact way they ask the problem on exam. The numbers are just different.
Yes.
So remember, the amount that has been depreciated over 3 years. The per year amount can be used to reduce the taxable income before taxes are calculated each year for the next 27 and a half years for residential property and 39 years for commercial property. Okay. You guys want to snap a picture of that slide? Go ahead. Shows you how to work it out. All right, so continuing chapter 17 here. We did this depreciation problem already, but let's, yeah, we already did this depreciation problem, so why are we starting off here? Okay, next up, the federal tax law limits the deductibility of losses on rental property. First $25,000 of loss can be used to offset income from any source. The investor must actively participate in the management of the operation of the property. We call that sweat equity. You know, it could be you cutting the grass or taking the garbage out or vacuuming the hallways or doing something along those lines. And you have taxable income less than $100,000 before the deduction is made. All right, so tax credit is a direct reduction in taxes due rather than deductions from income before tax is computed. Okay. So a tax credit is worth a lot more than an income tax deduction before you compute your taxes. So there's tax credits available for various things. Let's see, investors, let me see, tax credits, you could have them for historic properties. You could have tax credits that you could get for, what are they talking about here? The maximum income level, which a credit can also be taken as higher. Adjusted income is 200,000. Offset. Okay. You could also have tax credits for historic properties, but a lot of these tax credits are dealing not when you're using it as a residential property, but as a commercial. There's 10% tax. You could get a tax credit of 10% of rehabilitation cost for non-historic buildings placed in service before 1936. Or non-historic buildings must be non-residential property, commercial. The law also provides tax credits ranging from 4 to 9% each year over a 10-year period for expenditures on new construction or renovation on certain low-income housing. So there's tax credits for various things that you could get tax credits for. We explained in a previous chapter how the government was giving out tax credits when we had the mortgage meltdown and the real estate market crashing. They were giving tax credits trying to incentivize buyers to rush out and buy a home, put them in worse financial situations than they were in because the tax credit wasn't enough to cover the continued property loss of value after that. But either way, tax credits are more valuable than tax deductions. So a tax credit is a direct reduction in taxes due rather than calculating a deduction from income tax before it's computed. So tax credits are available to taxpayers who renovate historic properties, non-historic commercial buildings placed in service before 1936. Sometimes government offers tax credits like the stimulus, which I was talking about, where they offered that $7,500 credit and then another $11,000 credit between the 2008 to 2010. They were doing that when the mortgage market was crashing. Only thing is they incentivize all these people to rush out there and buy a house by giving them a tax credit, but they said you had to live in the house for at least 3 years. So when the tax credit went away and the property values continued doing their adjustment because they were overinflated artificially, when the tax credit went away, the property values continued to do that self-adjustment and fall. And then people wanted to get out of it. They did short sales and all that. They managed to avoid financial ruin. And then the IRS came knocking on their door. Hey, you need to pay us back that $7,500 or $11,000 that we gave you a tax credit for because you didn't live in the house for at least 3 years. So remember, there's that movie called The Big Short, which explains what happened back then, except they didn't get into the politics of how it came about. They just got into where you're already in a situation where the market's about to crash, and that's where they picked up in that movie. Okay, so let's do a side-by-side tax deduction versus tax credit so you could see which one is worth more. So in a tax deduction, if you have $100,000 of income, you subtract that $15,000 tax deduction that you may have for whatever reason, and then you have $85,000 left over, which then your taxes are based and computed off of that $85,000. So if you're in a 15% tax bracket, then you owe $12,750. If you're going to do a tax credit, it's added a different way. You take the $100,000 of income, and then you calculate your tax bracket. So you owe $15,000 in taxes. But if you got a $15,000 tax credit, now you owe nothing. So which one's more valuable? Tax credit is definitely more valuable, right? And you can see that it's plain as day when I made this example up, right? Okay. Well, I just made that example up. You don't need to know math on this or anything like that. I just put this together so that you could see that there's tax credit is worth more. All right. We've learned about land contracts, which are types of seller financing, right? We're also known as an installment sales contract, where the buyer makes payments towards the purchase and then they wait for the deed. They don't get the deed till it's fully paid off. So the buyer makes payments in installments and waits for the deed. The buyer has a financial interest called equitable title. but they're not the owner yet until they pay off the full amount owed. So there's complex tax rules, and it's figured on the investor's marginal tax rate. So we went over land contract in chapter 11 on page 220, but they just mention it here in a little blurb on page 331. So that's at the bottom of the page. So we learned about real estate investment syndicates in an earlier chapter too, as well as joint ventures. Now, business organizations, these are not legally formed business entities. They come together to carry out a business project, and when the project is done, the business entity is dissolved. A syndicate is a joining together of two or more people to carry out a business project. When the project is done, the syndicate's done. It's not a legally formed entity in that you don't got to go down and record documents to form a syndicate, and pay licensing fees and all that stuff like you do with an LLC or a corporation. A joint venture is similar to a syndicate, except instead of two or more people, it's two or more groups come together to carry out a business project. When the project's done, the joint venture's done. And then we have a real estate investment syndicate. This is a business venture in which a group of people pool their resources to own or develop a particular piece of property as an investment. Okay, so that's a real estate investment syndicate. That's like the little old ladies around the table. They pool their money together to invest in an investment property, a rental property, to earn income off of it, right? So here's a little warning for you as a real estate agent. You can be working in the business, and as you work in this business, you're going to see investors buying properties and that you didn't see how they could possibly be a profitable property, but you're going to see how they seek out properties, the types of properties they buy, and then what they do with them. Then after a while, you're going to be like, oh, I could spot a great investment a mile away. And you're going to get an idea, and you're going to be like, only if I had the money. So you got to be careful with this because sometimes these, if you're an agent, you get this idea that you want to buy a property as an investment, and you don't have the money. Instead, you advertise to try to get investors to invest in your project that you own. How are you going to try to get investors to invest in a project that you own? Well, you got to tell them what the upside is, right? You got to sell it. But you got to be careful with this because this could be classified as a security. And securities, you need to have special licensing to deal in securities. And those investments need to be registered with the FTC, the SEC, and the state of New Jersey themselves. So you could get in trouble in dealing with doing these types of ideas of trying to raise money for a property that you want to be the owner of, but you're going to pay out a profit or a share of that profit to any investor. Because it could be classified as a security. Securities need to also disclose what's the possible downside, not just the upside. So if you go and you get investors to invest in a project that you own, and then you get people who are not savvy in real estate as the investment, and they end up losing money, you're going to jail. Bye-bye. So this could be classified as a security. You're going to go to jail because you didn't have you weren't licensed to deal in securities, and it ended up ripping people off. This is like that Bernie Madoff type stuff. Remember that guy? He ended up going to jail for a long time. His kid went to jail. They ended up committed suicide in jail or whatever. But because they got sentenced for a long time, they ripped off a lot of people. I know there's a little more fraud involved with theirs than the intent, but either way. Special licensing is required to deal in securities, and the investment must be registered with the FTC and the SEC and the state of New Jersey. They got blue sky laws that regulate these things. It's a little bit different than the blue sky laws that don't allow, stores to be open on Sundays. We have some counties, or I'm not sure if it's the municipalities or the counties that have these old laws in place for religious reasons why you can't have stores open. Those fall under blue sky laws. There are some places in New Jersey that all the stores are closed on Sundays because of that. So such offerings must have a prospectus prepared, warning investors of the possible risk involved with the investment, not just the potential from the upside of the profits. So remember, we spoke also about partnerships in previous chapters. We have a general partnership and a limited partnership. In a general partnership, all the members share equally the managerial decisions. They share equal profits and losses, so they can be held liable for any additional debts that business takes on as well. All members are general partners that work in the day-to-day business activities. In a limited partnership, there's always at least one general partner who works in the business, and they're the one that's responsible for any additional debts the business takes on. But any other investors, they would be limited in their liability to the extent that the only thing they can lose is their initial investment in the business. Okay, that is the what a limited partner is. Maybe they buy stock. You know, the worst case, they lose their money on the stock. They can't be held liable for any additional debts the business takes on, any additional loans that they take out. All right. Let me see what slide this is here. Da, 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 23. Okay. What page is this? Oh, this is just referencing back to chapter 7, 123. All right, so REITs, we also went over this before. A REIT is a real estate investment trust. A REIT investors can get the same tax benefits as who? You'll need to study that for exam. Mutual fund investors. That's what you'll need to know for exams. This first bullet point. Who do REIT investors get the same tax advantages as? Mutual fund investors. Now, in order to have a REIT, a real estate investment trust, the REIT has to have at least 100 investors with at least 75% of that trust income coming from real estate as the investment vehicle. And of course, those investors need to have meet certain qualifications under IRS rules. But I'm not going to get into those. It's irrelevant to us here. Plus, I don't know them. So, but I know they need to have certain qualifications of so much in liquid assets and all that stuff. So highlight that if you didn't already. Oh, you already did back in chapter 7. So this is just a recap of this. But over here on page 333, we're going to write next to the title, see chapter 7, page 124, and then highlight exactly what you see at the bottom of the slide here. See chapter 7, page 124, and then highlight what a REIT is. And real estate investment trust investors get the same tax advantages as mutual fund investors. It's starting to get a little warm out. Wasn't expecting that.
Can I ask a question?
Sure.
What I mean, 70% of the trust income must came from the real estate the investment vehicle.
Yeah, so it's an investment, right? So the investment of this trust should be real estate.
Should be real estate.
The income should be coming from real estate as the investment.
So that if it's coming from another source of the income, it doesn't qualify. If the income coming from another source, the income.
75% of the trust's income has to come from real estate.
For real estate, okay.
The rest, I guess, could be from other things, maybe concession stands and things of that nature, that's
Yeah.
not in real estate.
Different kind of business.
Yeah. All right. So you don't need to have a real estate license to sell a business unless real estate's included in the sale. But we're not preparing the contracts for that anyway. All we'll do is market it, find a ready, willing, and able buyer, and pass it off to an attorney who will handle the transfer of the ownership of the business and the commercial real estate. Because when we talk about businesses, we're dealing with commercial real estate, right? So, do you need to have a real estate license to sell a business? The answer is no, unless real estate's involved, right? I could sell a web development company. There's no real estate involved. It's just a web. I'm selling you our business name, our goodwill, our client lists, our software, our things of that nature, but no real estate. So you don't need to have a real estate license then to sell a business. Okay. Now, when dealing with selling a business, things like trade fixtures, stock and inventory, the business name, customer list, goodwill, special rights like copyrights or patents, franchise licenses, ticket lottery machines, things of that nature need to be arranged. Let the attorneys handle that. Okay. So on page 333, you guys highlight their backwards way of saying you don't need a real estate license to sell a business. Instead, they word it this way. A person who sells or negotiates the sale of a business for others for a fee is required to be a licensed real estate broker. The exception is when business is sold without any real estate interest in any form. In other words, you don't need a real estate license to sell a business unless real estate's involved and included in the sale. So let's simplify that definition. This is on page 333, right? Page 333. Wording. So
Real estate itself is property, right?
yeah, real estate's the property.
Right.
Mhm.
Do not need to have a license. So
Okay. So how do you finance the purchase of a business? Well, you need to have cash or personal loans or what have you. It usually requires you to put down a lot of the substantial payment. You got to have a substantial amount of the money to buy a business, right? Hard to get those loans to purchase it. Okay, here's what you need to know for exams about commercial bulk. The commercial code, the UCC is the Uniform Commercial Code. We also learned about a UCC, which is the Uniform Construction Code, which is the state's minimum standard for construction. The UCC for the Uniform Commercial Code regulates the sale of businesses. Now, the part that deals with that we need to know about for exams is the Bulk Transfer Act, which regulates the sale of business personal property, that chattel. So highlight that the Bulk Transfer Act on page 334 is designed to protect the seller's creditors, you got to write that word sellers in there, from the fraud perpetrated by a business owner who sells the business, including the equipment and stock, and then disappears, leaving creditors unpaid. So if you're selling a business, you need to make sure, get an attorney involved to handle this part, or you need to make sure that the business owner makes a list of all outstanding debts to creditors. So they can't just say, hey, the business is for sale, everything's included, the stock, inventory, machinery. But they didn't pay it off yet. They're still making payments on it. So they still have outstanding debts to creditors that gave them that inventory, that stock and inventory or machinery on credit, right? You can't sell because you don't own it yet. So you need to make a list. The business owner needs to make a list of all outstanding debts to creditors that are still owed money. And then we need to provide that list to any potential buyers. And we need to notify the creditors that the business is for sale. So that if the seller sells the business and disappears, leaving those creditors unpaid, you just helped them commit fraud if you did not do this.
Wow.
You could be held guilty of a crime here, which I believe is a felony. You help them perpetrate that fraud on those potential buyers. That's why you need to make sure they make a list of all outstanding debts to creditors, supply that list to any potential buyers, and notify the creditors that the business is for sale. There's
So you
more-
have to
Yeah.
show them all outstanding bills. Okay.
Sorry? I couldn't-
You have to show them all outstanding uh
Debts.
debts. Yeah.
So anything that has not been paid off yet in full, like the machinery or inventory.
Mm.
Now, there's a statute of limitations in New Jersey for these bulk transfers. Unless the transfer has been concealed, creditors have 6 months to file any claim to personal property after the notice to creditors has been sent. If the notice to creditors has not been sent, the business is sold without first paying existing creditors. A creditor may enforce a lien on the goods and equipment of the business if they still belong to the original owner. You can find out more about this stuff by reading into it, but this is basically what we need to know for exams. What is the law that regulates the sale of business personal property, business chattel? The Bulk Transfer Act. And who does the Bulk Transfer Act protect in the sale of a business?
The seller?
No. The seller's creditors. The seller is the one that committed the fraud.
Oh, the creditors. Okay.
So it protects the seller's creditors from the seller committing such fraud. And does it protect the buyers too? Yeah, but kind of as a side effect, like the reason why you're required to get homeowners insurance when you're selling a home or when you're buying a home. Who does homeowners insurance cover?
Personal property?
No, who does homeowners insurance cover? Who is it insuring?
Or the homeowner?
The property. And
The
the home.
lender.
Huh?
Homeowners insurance insures the lender. When you get a loan, you're required to get homeowners insurance. Who's requiring you to get homeowners insurance? The lender. Otherwise,
Lenders.
they give you the loan. They want you to have insurance on that property that's to serve as collateral for the loan. So the homeowners insurance is not insuring you as the homeowner. It's insuring the
Lenders.
lender that lender's collateral. But does it also insure the homeowner? Well, yeah, you got to get a rider for your belongings inside and such, and eventually when you pay off the house, if you have homeowners insurance, it insures the borrower, the owner. But at the beginning, when you get that homeowners insurance, who does it cover? The lender it insures. So in the same way, the Bulk Transfer Act, it protects the creditors of the seller, but it also protects the buyers as a side effect, kind of like homeowners insurance does. Okay, so the UCC regulates the sale of a business. The act is designed to protect the business seller's creditors in the sale of a business. It also protects the buyer, but as a side effect, because they should be informed that the inventory and machinery or tools, the chattel of the trade, have not yet been paid for in full, and therefore can chase after the seller's personal assets to get reimbursed. So you should have highlighted on page 335, the requirements of the Bulk Transfer Act are designed to protect the interest of the buyer as well as those of the seller's creditors in the sale of the business. And non-compliance with this law is a criminal offense in New Jersey. So real estate is not covered under the Bulk Transfer Act, just the business personal property, that stock and inventory and machinery. So real estate brokers and salespeople are never allowed to draw up contracts for any commercial transactions. Licensees involved in business or commercial sales should advise the parties to consult their tax experts and attorneys before committing themselves. And then I have this slide, which explains everything pretty much about this again. What do you need to know for exams? The Bulk Transfer Act is part of the UCC, the Uniform Commercial Code. It prevents the fraud in the sale of business chattel. It protects the business seller's creditors from the seller selling the business and its inventory and equipment, saying it's included in the sale, but it has not yet been paid for in full. Then the seller leaves their creditors unpaid. It's fraud. And if you help them perpetrate that fraud, you too can be held guilty of that crime. Now, the Bulk Transfer Act is a part of Article 6 of the UCC that regulates the sale of businesses. So this is the part that regulates the transfer of chattel when selling a business. And it prevents fraud when a business is sold. And once again, it requires the seller to make a list of all outstanding debts to creditors and supply that list to potential buyers and notify the creditors the business is for sale. So everything I told you, I actually typed up and wrote on this slide here. So the real estate licensee must ensure these disclosures are made to avoid assisting the seller commit that crime, which then you could be held guilty of as well. So in New Jersey, the Bulk Transfer Act protects the sellers, creditors, and also the buyers. Non-compliance is a criminal offense. If an agent helps a seller perpetrate the fraud in the business sale, they can be held liable for helping commit that crime. So real estate brokers may not draw up contracts for commercial property or business transfers. That would be practicing law without a license. So only an attorney can handle those things anyway. We help market the property, but the contracts are drawn up by an attorney. So if you want a second to take a screenshot or take a picture of this screen, be my guest.
I did it.
Okay.
No problem.
And that concludes this chapter. So let's do the key terms to review for chapter 17. There are 2 of them. Are you ready?
I am ready.
Okay. So page 336. Key terms to review, page 336. Cost plus improvements minus depreciation. This is key terms 1.
Is that cash flow?
I'm sorry.
Immediate-
No.
Cost plus improvements minus depreciations. That's what?
Adjust basis.
Adjusted basis. Yes, 1 is A. Increase in value.
Appreciation.
Appreciation. 2 is B. Initial cost of the real estate.
The basis.
3 is C. Document transferring ownership of personal property.
Transferring.
How do we transfer the ownership of personal property?
What
That the bill
was
of
the
sale.
transfer? No.
The bill of sale. 4 is D. You guys should be noticing a pattern starting to form here. Extra money and property received by one party in an exchange. In the 1031 exchange, what do we call that extra money received by a...
Oh yeah, extra money is
that extra money that you're not reinvesting into the other property? What is that called?
Boot.
That's boot. 5 is E.
boot.
Law regulating the sale of financing of business personal property.
Bulk
Just
Transfer Act.
The Bulk Transfer Act. 6 is F. Yeah. You guys noticing the pattern yet? They didn't scramble up the answers
Yeah.
Yeah.
Uh-oh.
here. Okay, they forgot to do that. So, taxable profit on the difference between the adjusted basis and the net selling price of an asset.
Capital gain.
It's a capital gain. 7 is G. Money left from rental income after expenses are paid.
Cash flow.
Cash flow. 8 is H. Now, 9 is I. It's a horrible definition, so we're going to kind of skip it anyway. They put here a yearly bookkeeping charge for part of an initial cost. And they're looking for depreciation as the answer for that. That's a horrible definition, though.
Mhm.
Tax-deferred mutual transfers of income property.
Yeah, exchange.
Yeah, 10 is J, an exchange. And in particular, a 1031 exchange. But real estate held for rental income is called
Income property.
Income
income
property.
property. 11 is K. And that concludes the key terms to review 1. So 336. All right. Terms 2. Law regulating the transfer of business personal property.
UCC.
The UCC, the Uniform Commercial Code. Remember, there's 2 UCCs, so don't get them mixed up. Uniform Construction Code and Uniform Commercial Code. 10 is A. Refinancing property to buy more. What do you call it when you refinance property to buy more? Keep draining that equity out to buy more property.
Real estate investment?
Pyramiding. 4 is pyramiding.
Oh, that's what we use that model thing for.
Direct deduction. So 4 was B. Direct deduction from income tax due.
Tax
Tax
credit.
credit.
A tax
Tax
credit.
credit.
9 is C. Joining together of 2 or more people to carry out a business project.
Syndicate.
A syndicate. Correct. 8 is D. Group pooling resources to buy real estate.
Trust, real estate investment trust.
No, the one where we got the little old ladies pooling their money together to invest in an apartment building, maybe it's for their retirement to generate income from that.
Oh, group.
It's a real estate investment syndicate. It's not a formal business entity, but it's joining together of people to carry out a business project. It's a real estate investment syndicate. 5 is E, where they pooled their money together. 5 is E. A rate at which the investor's top dollar is taxed.
Top dollar.
Return.
No, what do we call the rate at which the investor's top dollar is taxed? Taxed.
Leverage.
The marginal tax rate. 3 is F. A sale in which a seller receives purchase price over a period of years.
Installment sale.
The installment sale. 1 is G. Extensive use of borrowed money for purchases. Extensive use of borrowed money for purchases. When you use someone else's money for an investment, it's the smart thing to do. That's what all the rich people do, actually. Little secret.
Leverage.
Real estate investment trust.
Leverage. It's called leverage. 2 is H. When you use other people's money, rich people, they don't invest their own money. Why are you going to risk your own money? That's stupid.
Mm.
You invest other people's money. So if you lose it, well, that was their
Yeah.
investment. They lose it. It's not, you're not risking your own money. This is what rich people do all the time. They say it's stupid. They take out loans to buy stuff as an investment. Okay, they don't use their own money, and then the interest is tax deductible on it that they pay for that loan. See, there's such thing as good debt and bad debt, right?
hmm
Good debt is the debt that you use to you borrow people's money, and you use that debt to invest in something that pays back. Good debt pays back. Bad debt is when you buy something that loses value instead of increasing the value. Like you use your money to buy a car, or you take out a loan to buy a car. Don't take out a loan to buy a car. When you take out a loan to buy a car, you got to pay that back. But that as you pay it back, the value of that item is dropping. That's bad debt. Okay. Good debt is when you buy something that continues to pay you back because you could collect rents on it. It increases in value over time, like real estate, right? That's good debt. These are some of the terms that these rich people do. Remember, I told you guys you should go out there and read some of those books like Robert Kiyosaki's Rich Dad, Poor Dad, or Donald Trump's The Art of the Deal. These types of people, these rich people, they're sharing their knowledge with you. But people don't actually. A lot of people don't look into it. Maybe Trump because they don't like him. But I mean, it's undeniable the guy is a genius when it comes to investing. People are like, oh yeah, but he got $1 million loan from his daddy. Okay, well, if I give you $1 million loan, can you turn it into hundreds of millions of dollars? Do you know how to do that? That's where the difference lies. We got to get these biases out of our head. The guy's a smart guy. He's got some knowledge. I'd like to learn about it. Maybe it could benefit me somehow. But also Robert Kiyosaki. Look at the Rich Dad Poor Dad. He gives you some of these principles too. Talks about good debt, bad debt. There's other investors out there too that you can learn things like this from. You got the one guy on. He was on. Actually, was he on Shark Tank? Yeah, I think he was on Shark Tank. But now he's got his own show on TV now. You see him a lot more where he goes in and sees businesses that need help. And he sees whether he's going to invest in that business and help partner with them. I forget the guy's name. He's a Greek guy. But he helps people. Oh, wait, actually, he's not Greek. I think he's, what the hell is he? I forget his background, but either way, he invests in businesses all the time. And you see his show all on TV all the time now on whether he's going to agree to become partners with you in your business and infuse some cash into it and put systems and processes in place to organize your business and let it take off the ground. So we should always look into what successful people do, and rid ourselves from the people who are so close around us that are negative. Only keep if you hang out, the people that are your best friends, the closest people around you that hang out with, it's pretty much a reflection on how you're going to end up. Hang out with successful people, be around successful people. Maybe some of that will rub off on you. And it's true, it does. If you open your ears, you unplug your ears and you start listening and taking some of that advice and watching what they do, some of it will rub off on you. But then again, if you hang out with somebody, they like to get drunk and high all the time, and they like the thug gang way of life or whatever. What's going to happen? You're going to be getting in trouble. You're going to be a nobody. You're not going to ever get rich or and not successful. You surround yourself around successful people, positive people, at least. Okay, so let's take a look. What was that last one we did? 5? Or yeah, no. We did 5 is E. Yeah. Okay. Rate at which the investor's top dollar is taxed. Oh no, we already did that. That was 3, the marginal tax rate. Sale in which the seller receives the purchase price over a period of years. That was an installment sales contract. We did that. Extensive use of borrowed money for purchases.
Leverage.
The leverage, that's the one we just did.
Yeah.
We're using other people's money. Okay, fund making real estate investments and selling shares. What kind of fund makes real estate investments and then sells shares?
Real estate investment trust.
Yes, a REIT, the Real Estate Investment Trust. And they get the same tax benefits as mutual fund investors. So 6 is I. Cash flow plus income tax savings plus appreciation. These are all examples of
Return.
a return. 7 is J. And that concludes chapter 17.